Is the U.S. economy right now as good looking as that view from Il Gatto Nero?
Yes, I think it's actually, I think it's better than what a lot of people think. Even just to sort of bring it back to sort of yesterday's data, right? Think about yesterday for a second. We had ADP that basically killed it relative to expectations. We have jobless claims that barely moved and remain at sort of near all-time lows. And this one little indicator, ISM services employment index, slowed. And that's all that anyone wanted to talk about yesterday in all of our conversations. So I just think there's so much asymmetry in place where a lot of attention is given to the negative and not enough attention is given to the positive. So and again, I think that's one of the things that we want to make sure people are clear on. We're not making the case for, hey, things are accelerating from here. We're simply making the case that we're probably not going to slip into a recession from here.
We're not.
No. I mean, not anytime soon. Obviously,
because I thought this inverted yield curve, which, by the way, has, what do they call it? Uninverted, de-inverted, non-inverted? I thought that was supposed to be this, flag and the siren about a recession.
Yeah, no, the curve, look, the curve has worked historically. There are reasons why it's not working now, not the least of which is the fact that you have negative yields around the world, and people obviously need some yield, so we're the, one of the few positive big industrial countries that are yielding something positive. So, and not only that, but and we've talked about this many times in some of our written research. I think what people have to keep in mind is 10-year yields are supposed to be a reflection of nominal growth, and there's a symbiotic relationship between these two. There's a massive divergence now between the two, right? Where nominal growth is basically up here and 10-year yields are down here. This gap is very big. Well. Then if 10-year yields are supposed to be a reflection of growth in the U.S. and they're not right now, that in and of itself is reason enough to discount the curve. So,
I just wonder if our yields are a reflection of anything fundamental other than the fundamental fact that there's $16 trillion worth of debt that's giving you, I think the technical term is squat on your money.
That's exactly it, right? So you can't look at 10s as a reflection of what's going to happen here from a growth perspective, and that's why the curve works, right? I mean, that's why we look at the curve. So yeah, we're pretty dismissive of that.
We look at this jobs number, and I'm not going to minimize the jobs number because we had ADP yesterday, and that sort of surprised everybody. Is there any chance, Tom, if we get a strong, $300,000 print on this jobs number, 300,000 print on this jobs number? 300,000 would be good. That'd be a good print for everybody out there. Does that take a rate cut September 18th off the table?
There's almost no sort of realistic / plausible positive number that you can get today that removes a rate cut from September.
So they're cutting, baby. They're going.
Yeah, definitely. And in fact, what we would say is, not only do you get a cut in September, but it seems likely that they're probably going to go one more time even after that. And again, as I've said to you and on this channel, this is not something that we necessarily believe the Fed should do, but this is what they are going to do.
By the way, quickly, we have these headlines crossing. Now on Wednesday, the Chinese cabinet said they were going to do this, so it's not exactly new news.
Yeah.
But China's bank cutting their reserve requirement. What that means in plain English is the amount of cash a bank in China needs to have on its books has been reduced. They do that so they have more cash to lend. They're basically, the government is saying, you don't need to save as much, Chinese bank, because now you can lend more money. That's what a cut in the reserve ratio, the RRR, as they say. Some would view that maybe as a scare, not a scare tactic, but a sign that they're worried about a weakening and slowing economy. Any way to read this vis-a-vis the U.S. economy?
How it comes back in? No, I think what it basically drives home is exactly what you just said. It's, look, they're trying to do what they can to sort of keep things moving along. But the bottom line is, while that's actually a wonderful outcome, from a stimulus perspective, I think what we have to recognize from a global central bank perspective is there's only so much central banks can do. And I said this to you last month when you and I were talking. This is not a monetary policy problem. This is a trade policy problem. There's only so much monetary policy can do to blunt the blow of what is happening in the world economy right now.